Let's move on to IFRS 10 when there's loss in control. Before we look at the principles, just a reminder that there is two approaches. Approach number one is that no consolidation occurred on date when control is lost. Approach number two, they have performed the consolidation process. Now, UNISA makes use of approach number one, where no consolidation occurred. Right. Now, guys, IFRS 10, paragraph 23. This is in the middle of your table. I want you to park this one. We are going to look at this after we've covered loss of control first. Right. Now, IFRS 10, paragraph 25, indicates to us what to do when there's a loss of control. It indicates to us that we will have to de-recognize, take out our assets and liabilities. We will have to recognize the investment retained, therefore the portion that they still do have, which will then normally be your IFRS 9 investment or your associate. Then they indicate to us we need to measure that investment based on B98, B2 and B99A. We are going to look at that in terms of the new fair value. Therefore, if there is a change from an associate to, from a subsidiary, if there's a loss of control from a subsidiary to an IFRS 9 investment, we need to measure the retained portion at fair value. And remember, when we look at associates, JVs, we talk about the cost. The associate or JV will be included at the cost. But it is important to note that the retained investment, the investment that we still have in that entity, should be measured at fair value on date when control is lost. Then I've included here for our financial assets, there might be a possible day one gain or loss. And step number 3, recognize your gains or your losses as per B98 to B99A. Therefore, B98 indicates to us how to calculate the gain or loss. IFRS 10 point B98 indicate to us how to calculate the gain or loss. Okay, now look at IFRS 10 B98 column for me, please. The how to calculate. We will have to de-recognize, therefore take out from a group perspective our assets and liabilities. This will include your goodwill and take out the carrying amount of your NCI. Now think about this, guys. In our group, the way that I see this is, if you think about a scenario, we have a selling price and we have a cost. Now a cost we take out, a selling price we include anything that we buy and sell, guys. Now if we look at this, and I'm going to include as follows, we need to take out the assets, liabilities, the portion relating to that subsidiary, and it includes your NCI in your group as well. And we need to bring in the proceeds received, the consideration. We need to bring in the portion that the entity still has, which can be the IFRS 9 or the associate, which should be at fair value. Therefore, if you look at step number 2, it indicates to us recognize, therefore in. Okay, let me just take out the positive, guys. Let's use the word in. We need to include, we need to take out, include the fair value of the consideration received. If shares were distributed, the retained investment at fair value, which we have indicated that we need to do this. And then number 3, if there's any OCI amounts, again, you need to transfer this to retained earnings. Look at this, your red principal. And then number 4, recognize the difference in terms of your gain or loss in your profit or loss of the parent. Okay, so look at this, guys. On the right side, in terms of your group, you will have to include the consideration received, the remaining portion plus if there is any shares issued. And then you will have to take out, therefore minus assets, liabilities, NCI. And this will be your group profit or loss. Okay, then if you refer to the last column on the right side of your table, again it indicates as previous amounts in OCI transferred to your retained earnings. And then B99A only for portion lost, important. Now, when we look at this, what is the type of changes that we can expect? Now, guys, remember, this can be a subsidiary that change into an associate, or this can be a subsidiary and change into a normal IFRS 9 investment. Therefore, we are now going to look at basic examples. In this example, we have a subsidiary and it changes into an associate. Again, we have entity A acquired 80% in entity B on 1 January 2020 at cost of 80,000, which is deemed to be the fair value. Entity A disposed of 40% of the shares in entity B for 60,000 on 1 July 2021, assumed to be an associate in terms of IAS 28 from this date. Entity B recognized a profit of 15,000 for the year ended 31 December 2020, and Entity B recognized a profit for the 6-month period till 30 June 2021 of 5,000. The net asset value of Entity B was 120,000 on date of disposal. Entity A accounts for the investments in associates and subsidiaries at cost in its separate financial statements in terms of IAS 27 paragraph 10A. Entity A elected to measure the non-controlling interest at proportionate share of the subsidiary's net identifiable assets. Then, year in 31 December, ignore all taxes, assume no consolidation occurred on date of change in control. Required, perform the journal entries in both records only relating to the information provided. Step 1. We have identified that we have 80% in entity B, which is a subsidiary, and they've sold 40% at 60,000 and now has 40%. Loss of control, therefore IFRS 10 B98. Let's move on to our timeline. Right, at the top of our timeline in terms of the separate records of entity A. This is a subsidiary. We need to account for this at cost based on IAS 27. Then it changed into an associate. Recognize this at cost in terms of IAS 27. Therefore, our first journal entry in the separate records of entity A at acquisition date will be to debit the investment with the 80,000 and to credit bank. Now, if you are standing on 1 July 2021 in the records of entity A sell 40%. You agree with me that we will now have to take out the 40%. Therefore, we debit our bank with the 60,000. We credit the investment with 40,000 because they're selling 50% of their shares, right? And we need to credit our profit on this sales transaction, which is 20,000. Your normal sales transaction, guys, take out the asset, include the amount received, and identify your profit or loss. Right. Now, in terms of our group records, and guys, I want you to think with me here. In terms of our group records, our at acquisition date, 1 January 2020, they've indicated to us our net asset value is 120,000 on 1 July. Therefore, if we calculate, and guys, if we take this back, the net asset value to 1 January 2020, And we need to determine what is the net asset value. How do we do this? We have the end amount. We need the beginning. Therefore, we use the 120,000 minus the 15,000 minus the 5,000. When you look at our timeline, the 15,000 minus the 5,000. And we will have a net asset value of 100,000 at the beginning on our at acquisition period. Therefore, we are able to determine the parent's portion is the 80,000. There is no goodwill, no bargain purchase. And our NCI's portion will be 20,000. Right? Remember, no consolidation occurred yet. Now, we know from the 15,000 to our parent, we will have to allocate. Let me just get my calculation here, guys. We will have to allocate to the parent and then to our NCI. Right, therefore we are able to identify that 80% should be allocated to our parent, 20% to our NCI, 3,000. Of the current year's profit, 80% to our parent and 20% to our NCI. Now, very, very important to remember, at this point of time, 1 July 2021, no consolidation occurred yet. We will have to debit our investment and subsidiary with the 16,000, 12,000 plus 4,000. We will have to debit our NCI with a profit portion only, the 1,000, not the 3,000, 1,000. We will have to credit our total profit or loss with 5,000 and credit our retained earnings, only the parent's portion, to include this into our consolidated financial statements. On 1 July 2021, if we look at this, what do? From a group point of view, this will now be an associate. Therefore, we will have to take out our subsidiary. But how? If we refer to our principles in terms of IFRS 10, we will have to de-recognize all of the assets and liabilities. But we have not yet included them because we have not yet consolidated. Guys, this is important. We have not consolidated. Therefore, we've not included that. Therefore, what we do is we now only determine what is our group profit or loss. This is what we now need to do. We need to determine the group profit or loss. How do we do this? We need to determine, de-recognize, take out the assets and liabilities and carrying amount of our goodwill. Our step number 1, we need to take out the assets and liabilities including goodwill and our carrying amount of our NCI. How do we do this? We know that our net asset value is the 120,000. Now our NCI will be how much? If we look at this, guys, I want you to follow the orange. Originally the 20,000 at acquisition date plus the 3 plus the 1. Therefore, we are able to determine that our NCI will be the 20,000 plus 3,000 plus 1,000, and this will be 24,000. And this is not 106, this is 96. That we need to take out. Right. What do we receive? What do we need to include? We still have the 40%, which is the associate portion. They've indicated to us that this is at fair value of 60,000 because the selling price, guys, was 60,000. Okay. Then we have what? We've received the consideration, therefore plus the consideration of 60,000. Okay. Therefore, this is what we have in the records. And this will be a difference of 24,000. Okay, so guys, just bear with me. Let's just have a look at our steps. Step number 1. Do you recognize assets and liabilities? Yes, we have the 120,000 in this example. Then the 24,000 relating to our NCI. And this is 96,000. Step number 2, recognize the fair value of the consideration. Yes, this is the 60,000. If shares were distributed, no. The retained investment at fair value, yes, this is the 60,000. Therefore, we are able to determine that we will have a group profit of 24,000. Okay, this is your group profit. How do we recognize the group profit? We will have to credit profit. Therefore, if we look at a journal entry, we credit our profit on the sale of 24,000. But I want you to remember, we need to take out the profit in the separate records. The profit recognized at the top. The profit in the separate records, the 20,000, we now need to take out. Because we can't have profit, because remember, if you think about this, when we consolidate, we're going to add the 20,000 in our group. But for group purposes, the profit is the 24. So we can't add 20 and 24. We can't add 20 and 24. Okay, guys? Therefore, we need to take out the profit relating to the separate records. And this is the 20,000 because from a group perspective, the profit is 24,000. Then we need to include, and this is as per IFRS 10 paragraph 25. We need to include the investment in the associate at fair value. Now look at this. At fair value, which is the 60,000. And we will then credit our investment in the subsidiary with a balancing figure, and this will be an amount of 56,000. Okay, so let me just quickly recap. We had to calculate the group profit, which is the 24,000. We've calculated this by means of the principles of IFRS 10B98, right? We need to recognize the group profit. On date of disposal, this is still a subsidiary. Therefore, if we consolidate, we will include the 20,000 relating to the separate records into our group. But for group purposes, the profit is 24,000. Therefore, we need to take out the profit in the separate records. And then IFRS 10:25, paragraph 25, indicates to us that investment in the associate should be included at fair value. Look at this, guys. Look at this. We need to recognize the investment retained at fair value. This will be the new fair value. Okay. Now, don't get confused with the fact that I've indicated here or. Reminder, separate records. This is at cost. I'm going to indicate this to you just now. Okay. And the separate records, the fair value will be in terms of IFRS 9 on initial recognition. I'm going to show this to you just now. Therefore, if you look at the separate records for me here, at the top, our investment is still included at cost because originally this was 80,000 and we took out 40,000 and we have 40,000, which is still our original cost. But for group purposes, it's 60,000. And then, as always, our journal will balance. Therefore, we will credit our investment in subsidiary. Now, let me just show to you, and I just quickly want to indicate this to you. What is important now here is, if you look at this, again, guys, at the top, the associate is included at cost. At the bottom, the associate is included at fair value, right? Now, work with me here, guys. If we look at the subsidiary from a group perspective, you agree with me that before disposal now, Guys, look at this. Before disposal, we have not consolidated. This subsidiary is still included at cost, being the 40,000, right? Then, number 2, we have included, I'm running out of colors, we've included this journal, debit the investment with the 16,000. Debit the investment with the 16,000. Right? This is just before the disposal date. You agree with me that this is 56,000. Right. Now, we dispose and we credit the investment with the 56,000. Therefore, we are able to identify on disposal date there is no subsidiary left and only the investment in associate at fair value. Okay guys, quite a mouthful, I know. You agree with me. As of 1 July 2021, we will have to then follow our rules in terms of IFRS 28. But now, guys, the cost of this investment from a group perspective will now be the 60,000 because that's the fair value that's included in our group currently. Guys, I know, a mouthful, hey? Now let's just take one step back. Important to remember, based on the UNISA approach, no consolidation occurred at date when control is lost. Now, if we look at the separate records of Entity A, Entity A will have to recognize the sales transaction. Therefore, we will recognize a profit or loss on the sale transaction. That's it, guys. Take out the investment, include bank, recognize profit or loss. For group purposes, 1, we will have to take out that profit or loss relating to the separate records. 2, we will have to include our group profit or loss, which we calculate in terms of IFRS 10 B98. Remember, we've calculated this. Take out the assets, liabilities, carrying amount. Identify what should still be included. And then step number 3. Within this journal, ensure that your associate is included at fair value.